Welcome to the IRS webinar determining full-time employee status under the Affordable Care Act. At this time, it is my pleasure to turn the floor over to Lori Stieber. Ma'am, the floor is yours.
Thank you, and welcome. Today, we're presenting information about tax provisions under the Affordable Care Act, or ACA, for which many questions have been received by the IRS. Specifically, we'll address the determination of full-time employee status as it applies to the employer shared responsibility provisions of the ACA. You'll hear examples and scenarios that require you to be familiar with ACA terms, such as applicable large employer, or ALE, measurement periods, and hours of service. This presentation is being recorded. You'll be able to access this recording and other topics at our video portal located at www.irsvideos.gov/governments. The information contained in this presentation is current. For the latest information about tax provisions of the Affordable Care Act, visit irs.gov/ACA. I'm Lori Stieber, and presenting along with me is Mary Rogers. Mary and I are both internal revenue agents and government entity specialists with FSLG, federal, state, and local governments. FSLG is an office within TEGE, tax-exempt and government entities, a division of the IRS.
Thanks, Laurie, and good to be working with you again. Employers have many questions regarding the Employer Shared Responsibility provisions of the Affordable Care Act, or ACA. Generally speaking, the Employer Shared Responsibility provisions found in Section 4980H of the Internal Revenue Code provide that an applicable large employer, or ALE, is liable for an assessable payment if any full-time employee receives the premium tax credit and the ALE either, 1, did not offer coverage to at least 95% of all full-time employees, or 2, offered coverage, but the coverage was not affordable or did not provide minimum value. An employer is an ALE if the average number of full-time employees, including both full-time employees and full-time equivalent employees, during the preceding year is 50 or more. It's important to note that if an employer has fewer than 50 full-time employees, the employer is generally not considered to be an ALE. More specifically, an employer is not an applicable large employer for a year if it has fewer than 50 full-time employees, including full-time equivalent employees. This is determined based on employment information from the prior year. Another important rule to note is the Aggregation Rule that applies to entities with common ownership. Under a long-standing provision that also applies for other tax and employee benefit purposes, companies with a common owner or that are otherwise related generally are combined and treated as a single employer for determining ALE status. An employer must identify its full-time employees to determine if it is an ALE. See Section 414, paren B, paren C, paren M, or paren O of the Code, referred to as the 414 or Controlled Group Rules. If the combined number of full-time and full-time equivalent employees for the group is large enough to meet the ALE definition, then each company in the group is called an applicable large employer member and is considered to be an ALE, even if separately they would not be. You will want to note that although companies with a common owner or that are otherwise related generally are combined and treated as a single employer for determining ALE status, potential liability under the Employer Shared Responsibility provisions is determined separately for each ALE employer.
Thanks, Mary. An employee is considered full-time for a calendar month if that employee averages at least 30 hours of service per week, or 130 hours per month. An hour of service is each hour for which an employee is paid, or is entitled to be paid, for the performance of duties for the employer or for a period of time during which no duties are performed, including due to holiday, vacation, illness, and other types of leave. The number of full-time equivalents is determined by combining the total hours worked by every employee who is not a full-time employee, but not more than 120 hours for any one employee in a month, and dividing the result by 120. The employer must look at all of its employees when counting heads for applicable large employer, or ALE status, including seasonal workers, defined as a worker who performs labor or services on a seasonal basis as defined by the Department of Labor. This includes retail workers employed exclusively during holiday seasons. Although the employer must look at all of its employees when counting heads for ALE status, there is an exception for how to count seasonal workers. If the employer had more than 50 full-time and full-time equivalent employees for 120 days or less, and the number in excess of 50 were seasonal workers, the seasonal workers can be excluded from the count. As a result, the employer will not be an applicable large employer. This exception sounds complicated, but the regulations include examples for counting seasonal workers. The Surface Transportation and Veterans Health Care Choice Improvement Act of 2015 provides that an employee will not be counted toward the 50-employee threshold for a month in which the employee has medical care through the military, including TRICARE or veterans coverage. This is solely for the purpose of determining whether an employer is an ALE subject to the employer shared responsibility rules of Code Section 4980H. For more information, see Code Section 4980H, paren C, paren 2, subparagraph F, exemption for health coverage under TRICARE or the Veterans Administration.
That's good information, Laurie. Thanks. The identification of full-time employees is significant for multiple reasons. An employer must identify its full-time employees to determine whether it is an applicable large employer, or ALE. An employer must identify its full-time employees to determine to whom it needs to offer coverage to avoid an assessable payment. The number of full-time employees provides a basis for an IRS calculation of the potential assessable payment. And additionally, the ALE will use this information to comply with information reporting requirements under Code Section 6056. There are two methods an employer may use to determine whether an employee is a full-time employee for purposes of Section 4980H: the monthly measurement method and the look-back measurement method. Under the monthly measurement method, the employer determines whether an employee is a full-time employee on a month-by-month basis by counting the employee's hours of service for each month. The other method is the look-back measurement method, under which an employer may determine the status of an employee as a full-time employee during a future period, referred to as the stability period, based upon the hours of service of the employee in a prior period, which is referred to as the measurement period. The look-back measurement method for identifying full-time employees is available only for purposes of determining and computing liability for an employer shared responsibility payment, and not for purposes of determining if the employer is an ALE. The Section 4980H regulations describe approaches that can be used for various circumstances, such as for employees who work variable hour schedules, seasonal employees, and employees of educational organizations. These two methods prescribe minimum standards for the identification of full-time employee status. Employers always may make additional employees eligible for coverage or otherwise offer coverage more expansively than required. Note that the look-back measurement method for identifying full-time employees is available only for purposes of determining and computing liability for an employer shared responsibility payment, and not for purposes of determining if the employer is an applicable large employer.
Thanks, Mary. For the look-back method, employers may determine the status of an employee as a full-time employee based upon hours of service in a preceding period, which is referred to as the measurement period. The status determined based on the employee's average hours of service in the measurement period must be applied throughout the following stability period. An employer who chooses to use the look-back measurement period must set a standard measurement period, which applies to ongoing employees, that is, not newly hired employees, and an associated stability period. Employers must set their standard measurement period to end before the associated stability period begins. If an employee averages at least 30 hours per week during the standard measurement period, the employee is a full-time employee for purposes of Section 4980H for each month of the associated stability period. When applying the look-back measurement method to newly hired employees, different rules apply depending on whether or not the employee is reasonably expected to be a full-time employee at the time of hire. If an employee is reasonably expected to average 30 or more hours per week at the time of hire, the employer must determine that employee's status as a full-time employee based on actual hours of service each month, as under the monthly method. If the employee is a variable hour employee at the time of hire, meaning that the employer cannot reasonably determine if the employee will average 30 or more hours per week, the employee's status as a full-time employee is determined after an initial measurement period. For purposes of determining if an employee is a variable hour employee, an employer may not take into account the likelihood that the employee could terminate employment before the end of the initial measurement period. Importantly, employers, educational employers, also cannot take into account the potential for or likelihood of an employment break period in determining the expectation of future hours of service. Variable hour positions might include adjunct professors, substitute teachers, retail workers, volunteers, and others who work irregular schedules and have variable hours. Whether it's reasonable to expect a new hire to average 30 or more hours per week depends on the facts and circumstances. Factors to include, but are not limited to, whether the employee is replacing an employee who was or was not a full-time employee, the extent to which employees in the same or comparable positions are or are not full-time employees, and whether the job was advertised, communicated, or documented to the new hire as requiring hours of service that would average 30 or more hours per week or less than 30 hours per week.
An employer using the look-back measurement method may also establish an administrative period, generally of up to 90 days in length, between the standard or initial measurement period and the associated stability period. An administrative period provides employers time to process paperwork, determine whether employees are eligible for benefits, and to notify and enroll employees. An administrative period also includes time before the initial measurement period. The applicable time before and after the initial measurement period and before the stability period is limited to 90 days. Any administrative period between the standard measurement period and the stability period may neither reduce nor lengthen the measurement period or the stability period. The standard measurement period chosen by the employer must be from 3 to 12 months. The initial measurement period for new employees must be the same length as the standard measurement period. And the stability period for new employees must be the same length as the stability period for ongoing employees. The minimum length of a measurement period is 3 months, but the minimum length of a stability period for an employee who is a full-time employee based on hours of service in a measurement period is 6 months. For ongoing employees with less than full-time hours, the length of the stability period cannot exceed the length of the measurement period. Laurie, could you provide an example?
Sure can, Mary. Here's an example. Employer Z is an applicable large employer that computes hours of service following the look-back method for ongoing employees. Employer Z chooses to use a 12-month stability period that begins January 1st and a 12-month standard measurement period that begins October 15th. Under the terms of Employer Z's health plan, only employees classified as full-time using the look-back method are eligible for coverage. Employer Z chooses an administrative period between the standard measurement period, which ends October 14th, and the stability period, which begins January 1st. Employer Z uses this time to determine which employees were employed on average of 30 hours per week during the measurement period, notify them of their eligibility for the plan for the calendar year and of the coverage available under the plan, answer questions and collect materials from employees, and enroll those employees who elect coverage in the plan. Previously determined full-time employees already enrolled in coverage continue to be offered coverage through the administrative period. Employee A has been employed by Employer Z for several years, continuously from her start date. Employee A was employed on average 30 hours per week during the standard measurement period that begins October 15th, 2015, and ends October 14th, 2016, and for all prior standard measurement periods.
In our conclusion, we see that because Employee A was employed for the entire standard measurement period that begins October 15, 2015, and ends October 14, 2016, Employee A is an ongoing employee with respect to the stability period running from January 1, 2017 through December 31, 2017. Because Employee A was employed on average 30 hours per week during that standard measurement period, Employee A is a full-time employee for the stability period and is offered coverage for the entire 2017 stability period, including the administrative period from October 15, 2017 through December 31st, 2017. Because Employee A was employed on average 30 hours per week during the prior standard measurement period, Employee A is offered coverage for the entire 2016 stability period and, if enrolled, would continue such coverage during the administrative period from October 15, 2016 through December 31st, 2016. Employer Z complies with the rules for using the look-back method because the standard measurement period is no longer than 12 months. The stability period for ongoing employees who are full-time employees based on hours of service during the standard measurement period is not shorter than the standard measurement period, and the administrative period is no longer than 90 days. If an ongoing employee experiences a change in employment status before the end of a stability period, the change will not affect the classification of the employee as a full-time employee or not a full-time employee for the remainder of the stability period.
Thank you, Mary. Another example demonstrates the use of an initial measurement period and an administrative period by using an 11-month initial measurement period followed by a 2-month plus administrative period, and then by a 12-month stability period. 2-month plus means 2 calendar months following the end of the 11-month initial measurement period, plus, if necessary, to make the administrative period end on the last day of a month, an additional partial month. Here are the facts in this example. For new variable hour employees, ABC Company uses an 11-month initial measurement period, followed by a 2-month plus administrative period. ABC Company hires employee Annabelle on May 10, 2015. At the time of hire, the employer cannot determine if Annabelle is reasonably expected to average 30 or more hours of service per week. Her initial measurement period runs from May 10, 2015 through April 9, 2016, and Annabelle has an average of 30 hours per week during this initial measurement period. The 2-month plus administrative period associated with her initial measurement period ends on June 30, 2016. Based on her hours of service during the initial measurement period and associated stability period, Annabelle is a full-time employee for the stability period, which runs from July 1, 2016 through June 30, 2017. ABC Company offers affordable coverage that provides minimum value to Annabelle starting July 1, 2016.
In conclusion, ABC Company uses an initial measurement period that does not exceed 12 months, an administrative period totaling not more than 90 days, and a combined initial measurement period and administrative period that does not last beyond a month after Annabelle's first anniversary as an employee. Accordingly, ABC Company complies with the rules for the initial measurement period and stability period for a new variable hour employee. For the period starting with Annabelle's date of hire through June 30, 2016, Annabelle is not a full-time employee for purposes of Section 4980H. Accordingly, ABC will not owe an assessable payment under Section 4980HA or B for Annabelle. For each month of the stability period starting July 1, 2016, ABC could potentially owe an assessable payment for Annabelle if ABC were to withdraw the offer of coverage or if the coverage is not affordable coverage that provides minimum value. A couple of important side notes as we mention 4980H reporting. Our ABC Company example reflects a fiscal year that is distinct from the calendar year and also reflects a coverage plan year that is distinct from the calendar year. Regardless of the fiscal year or coverage plan year of an employer, payment under Section 4980H is assessed on a calendar year basis based on information reports that are required to be filed after the end of each calendar year. However, the amount of any assessable payment is determined month by month, so an employer could potentially owe a 4980H payment for some months but not others. Also, employers will know if an assessable payment under Section 4980H is imminent when the IRS contacts them to inform them of a potential liability. The IRS provides employers a chance to respond before assessment or notice in demand for payment is made.
You know, we receive many questions regarding changes in employee status. Employees may start out as part-time and then work full-time or vice versa. And sometimes employees transfer from one reporting group member to another. At what point can an employer that is using the look-back measurement method treat a full-time employee as no longer a full-time employee? Once an employee is in a stability period in which the employee is treated as a full-time employee based on hours of service during the associated measurement period, the employee remains classified as a full-time employee for purposes of Section 4980H for every month of the stability period. This is true even if the employee's average hours of service change during the stability period, such as when an employee switches to a position with a reduced work schedule. If an employer fails to offer coverage to a full-time employee for any month of the stability period, the employer could potentially owe an assessable payment under Section 4980H for that month. If an employee transfers to another position where a different measurement period applies, such as when an employee moves from an hourly position with a 12-month measurement period to a salaried position with a 6-month measurement period, the employee may be entitled to a transition period during which the employee must be treated as full-time if the employee averaged at least 30 hours per week under either of the two measurement periods. Employers must track the service hours to accurately determine the status of the employee for 4980H purposes throughout this transition period.
Thanks, Laurie. Under the look-back method, employers count service hours during a measurement period to determine the employee's full-time status during a stability period. How does the employer calculate hours of service for employees who are paid on a non-hourly basis? Employers must realize that except as otherwise provided, under the look-back measurement method and the monthly measurement method for employees paid on a non-hourly basis, an employer must calculate hours of service by using one of the following methods: using actual hours of service from records of hours worked and hours for which payment is made or due, using a day's worked equivalency where the employee is credited with 8 hours of service for each day for which the employee would be required to be credited with at least 1 hour of service, or using a week's worked equivalency whereby the employee is credited with 40 hours of service for each week for which the employee would be required to be credited with at least 1 hour of service. While an employer must use one of the 3 methods for calculating the hours of service for non-hourly employees, an employer is not required to use the same method for all non-hourly employees and may apply different methods for different categories of non-hourly employees, provided the categories are reasonable and consistently applied. Similarly, an ALE member is not required to apply the same methods as other members of the same ALE for the same or different categories of non-hourly employees, as long as the categories are reasonable and consistently applied by the member. An employer may change the method of calculating the hours of service of non-hourly employees or of one of more categories of non-hourly employees for each calendar year. However, the number of hours of service calculated using the days worked or weeks worked equivalency must reflect generally the hours actually worked and the hours for which payment is made or due. An employer is not permitted to use the days worked equivalency or the weeks worked equivalency if the result is to substantially understate an employee's hours of service in a manner that would cause the employee not to be treated as a full-time employee, or if the result is to understate the hours of service of a substantial number of employees, even if no particular employee's hours of service are understated substantially, and even if the understatement would not cause the employee to not be treated as a full-time employee. For example, an employer may not use a day's worked equivalency in the case of an employee who generally works 3 10-hour days per week, because the equivalency would substantially understate the employee's hours of service as 24 hours of service per week, which would result in the employee being treated as not a full-time employee. The reasonable methods we mentioned are not intended as the only reasonable methods of crediting hours of service. Reasonableness is based on the relevant facts and circumstances. However, the sole purpose of any method should never be to reduce the hours credited such that the employee is not recognized as full-time.
The look-back method contains rules for new employees who are reasonably expected to be full-time employees at the start date, and rules for those who are variable hour employees or seasonal employees. A variable hour employee or seasonal employee will have his or her status as a full-time employee determined after an initial measurement period. The determination of which employees are seasonal employees may be important for applicable large employers, or ALEs, because seasonal employees, like variable hour employees, are not required to be treated as full-time employees for purposes of Section 4980H as of the date of hire, but instead have their status determined only after completion of an initial measurement period of up to 12 months. A seasonal employee is defined as an employee who is hired into a position for which the customary annual employment is 6 months or less. For a newly hired seasonal employee who is expected to average at least 30 hours per week, an employer can use the look-back method and track hours of service over the duration of the initial measurement period. The likely result is the employee would not qualify as a full-time employee for Section 4980H purposes because the average weekly hours of service would be determined based on the total number of weeks in the measurement period, including weeks in which the employee had no hours of service. Technically, a seasonal employee means an employee in a position for which the customary annual employment is 6 months or less. The reference to customary means that by the nature of the position, an employee in this position typically works for a period of 6 months or less, and that period should begin annually in approximately the same part of the year, such as summer or winter. In certain unusual instances, the employee can still be considered a seasonal employee, even if the seasonal employment is extended in a particular year beyond its customary duration, regardless of whether the customary duration is 6 months or is less than 6 months.
When should an employer recognize the employee as not seasonal if that employee switches to a non-seasonal position before the end of the initial measurement period? If, during the initial measurement period, a seasonal employee switches to a position that is not a seasonal position and is reasonably expected to average at least 30 hours of service per week in the new position, the employer generally must treat the seasonal employee as a full-time employee for Section 4980H purposes any month after the switch in position in which the employee averages 30 or more hours per week. However, the employer generally will not owe an assessable payment for the first 3 calendar months after the switch, provided that the employee is offered coverage no later than the first day of the 4th calendar month after the switch, or the first day of the first stability period, if earlier, provided that the employee averaged at least 30 hours per week during the initial measurement period.
We've been talking about seasonal employees who shift to non-seasonal positions where they are reasonably expected to work at least 30 hours per week, i.e. a full-time employee, and we'll provide an example of that. First, we want to reflect on the rules that apply to an employee who is reasonably expected at date of hire to average at least 30 hours per week. The employee is not placed into an initial measurement period, but is instead classified as a full-time employee for purposes of Section 4980H for any month in which the employee has at least 130 hours of service. An employer will not be subject to the employer responsibility payment under Section 4980H for failing to offer coverage for any calendar month of the 3-month period beginning with the first day of the first full calendar month of employment, if, for the calendar month, the employee is otherwise eligible for an offer of coverage under a group health plan of the employer, provided that the employee is offered coverage by the employer no later than the first day of the 4th full calendar month of employment, if the employee is still employed on that day. And if the offer of coverage for which the employee is otherwise eligible during the first 3 full calendar months of employment, and which the employee is actually offered by the first day of the 4th month, if still employed, is affordable coverage that provides minimum value, the employer is also not subject to an assessable payment under Section 4980HB with respect to that employee for the first 3 full calendar months of employment.
Let's review an example with a change in status for a seasonal employee to full-time employee. Annabelle is hired as county park groundskeeper by the county on May 1st, 2017. Initially, Annabelle is an hourly seasonal employee. The county uses a look-back method to calculate hours of service for hourly employees. The county uses a 12-month initial measurement period. Annabelle's initial measurement period begins on May 1st, 2017, and ends on April 30th, 2018. Annabelle is promoted to a non-seasonal position of grounds manager on July 1st, 2017. Annabelle averaged 30 or more hours per week during the period from May 1st, 2017 through June 30th, 2017. To avoid a 4980H payment, the county must offer coverage as of October 1st, 2017. However, the county may offer coverage sooner to comply with the 90-day limitation on insurance coverage waiting periods.
We've received questions regarding how the service hours of adjunct faculty members are counted. Employers of adjunct faculty or non-hourly employees in comparable positions are required to use a reasonable method for crediting hours of service consistently with Section 4980H to determine if they're full-time employees. Employers may apply a safe harbor method, which will credit an adjunct faculty member of an institution of higher education with 2.25 hours of service, representing a combination of teaching or classroom time and time performing related tasks such as class preparation and grading of examination papers per week for each hour of teaching or classroom time, and 1 hour of service per week for each additional hour outside of the classroom the faculty member spends performing duties he or she is required to perform, such as required office hours or required attendance at faculty meetings. Let's go over an example. If an adjunct faculty member taught 8 credit hours in a semester and had no other required responsibilities, his or her effort would be calculated under the safe harbor at 8 credit hours times 2.25 equals 18 hours. Additionally, the adjunct is required to work an additional 5 office hours per week. This adjunct works a total of 18 plus 5 equaling 23 hours per week. Consequently, an employer would not owe an assessable payment under Section 4980H, whether or not the employer chose to offer this employee coverage. If a state determines all state agencies, including its colleges and universities, are within the same controlled group, work performed for another state agency must be taken into consideration. Service hours must be counted across an employer's entire controlled group. Service hours must be counted across an employer's entire controlled group. For example, an employee who for a month averaged 25 hours of service per week at one ALE member and 15 hours of service per week at another ALE member of the same ALE would be a full-time employee for that month.
Breaks in service may impact an employee's status as a full-time employee under the look-back method. Let's cover some important concepts about these periods of time first and then provide examples. If an employee experiences a break in service and then resumes providing services for the same employer some weeks later, the Section 4980H regulations provide rules for determining when the employee may be treated as a new employee versus an ongoing employee. If the employee is treated as a new employee under these rules, the employee begins an initial measurement period as if the employee were a new hire as of the date of resumption of services, called the rehire date. The employee would also lose any pre-existing status as a full-time employee under the look-back measurement method, and any hours of service prior to the rehire date would be disregarded.
An employee must be treated as a continuing employee for purposes of Section 4980H rather than a new employee unless the employee has had a period of at least 13 weeks during which no hours of service were credited. For employers that are educational organizations, the period is at least 26 weeks during which no hours of service were credited. Under an optional rule of parity, an employer may also treat an employee as a new employee upon resumption of services after a period that is at least 4 consecutive weeks' duration and is longer than the employee's immediately preceding period of employment. For example, Assume an employee was hired in January, worked for 3 weeks, then had a period of 5 consecutive weeks during which the employee was credited with no hours of service. Under the rule of parity, the employer may treat the employee as a new employee after the 5-week break in service because the length of the break in service is longer than 4 weeks and also longer than the prior period of employment, which was 3 weeks. With regard to certain break periods, including employment break periods for employees of educational organizations and periods of special unpaid leave, which would include FMLA, jury duty, and other special categories of leave, an ongoing employee who returns after a break in service must be credited with hours of service for the period during which no services were performed. An employment break period is, for an employee of an educational organization, a period of at least 4 consecutive weeks during which the employee is credited with no hours of service. The number of weekly hours of service required to be credited to an employee for an employment break period or period of special unpaid leave is based on the employee's weekly average hours of service of the most recent measurement period, after excluding any special unpaid leave. In the case of an educational organization, also exclude any employment break period and use that average for the entire measurement period. Alternatively, the employer could credit the employee with hours of service for periods of special unpaid leave at the average weekly rate the employee had during the weeks in the measurement period, as long as they are not part of a special unpaid leave period. In the case of an educational organization, the employer could credit the employees with any employment break period during that measurement period. The employer would never be required to exclude or credit more than 501 hours of service during employment break periods in a calendar year. No such limit applies for special unpaid leave. Note that employers may use any reasonable method to determine the average weekly number of hours of service to be credited during an employment break period or a period of special unpaid leave, provided that the method is applied on a consistent basis. If an employee's average weekly rate is being computed for a measurement period and that measurement period is shorter than 6 months, the 6-month period ending with the close of the measurement period is used to compute the average hours of service.
We have 2 examples of how to handle employee breaks in service. In this first example, the facts are as follows. Donna is employed by XYZ School. She works for 38 hours per week on average from September 7th, 2014 through May 23rd, 2015, and then does not work and is not otherwise credited with an hour of service during the summer break when the school is generally not in session. Donna resumes work for XYZ School on September 6th, 2015, when the new school year begins. Has Donna terminated? Because the period from May 24th, 2015 through September 5th, 2015, which is a total of 15 weeks, during which Donna is not credited with an hour of service, because that does not exceed 26 weeks and also does not exceed the number of weeks of her immediately preceding period of employment, Donna is not treated as having terminated employment on May 24th, 2015, and having been rehired on September 6th, 2015. Also, for purposes of determining average hours of service per week for the measurement period, Donna is credited under the averaging method for employment break periods applicable to educational organizations. She's credited as having an average of 38 hours of service per week for the 15 weeks between May 24th, 2015 and September 5th, 2015, during which she otherwise was credited with no hours of service.
For another example about breaks in service, let's use the same facts as our previous example, except that Donna does not resume work until December 5th, 2015. Because the period during which she performs no services is longer than 26 weeks in this example, she may be treated as a new employee on December 5th, 2015, for purposes of Section 4980H. Any hours of service prior to her rehire date are disregarded, and the period between termination and rehire with no hours of service is not taken into account in the new measurement period that begins after Donna is rehired. The averaging method for employment break periods applicable to educational organizations does not apply because she's treated as a new employee rather than a continuing employee as of the rehire date.
We want to draw attention now to question and answer 15 from Notice 2015-87, which addresses arrangements where employees of third-party organizations or staffing agencies are performing services primarily with educational organizations. The question asks, is an employee who primarily performs services for one or more educational organizations but is not an employee of the educational organization subject to the special rehire rules and employment break period rules? Would he or she be treated as a new employee only after a break of at least 26 consecutive weeks? And if the employer is using the look-back measurement method, would he or she be subject to the special hours of service averaging rules? In response to these questions, Treasury and the IRS intend to amend the regulations under Section 4980H to address the application of these rules to employees who primarily perform services for one or more educational organizations through a third-party, non-educational employer.
Well, we have addressed some common scenarios present with application of the look-back method. We specifically followed the regulations issued under Section 4980H, FAQs on employer shared responsibility provisions, and Notices 2012-58, 2014-49, and 2015-87. Here we have two final slides that contain resources for you, along with links to important information. We've highlighted several links in particular, two of which you can see now. The link to Internal Revenue Code Section 4980H Q&As, and the link to legal guidance and other resources. Now Mary will point out additional resources.
You can also link to Internal Revenue Code 4980H final regulations from these slides. Next, check out the Aca Estimator Tools available on IRS.gov, where you'll find a link to the Taxpayer Advocate Services Employer Shared Responsibility Provision Estimator. This estimator helps employers understand how the provision works and how it may apply. Thank you for taking the time today to better understand these provisions of the Affordable Care Act.